Welcome to our deep dive. Our mission today is very specific, highly technical, and I think completely essential if you trade the short end of the market.
I agree.
We are cracking open the institutional playbook for what is really a pivotal week. We're drawing directly from the reserve of KING-KAMBUF Financial News and Reports Magazine Weekly Market Digest and Investment Analysis.
And this isn't just, a news summary. This is institutional grade analysis.
Yeah,
It's designed to give you actionable trading strategies.
right.
We're looking at data from Monday, December 8th, and our job is to translate that movement into high probability coordinates for the rest of this really critical week.
Especially for certain kinds of traders.
Exactly. Specifically for those swing and day traders who rely on structured methodologies, something like the TKI 20+ framework.
So our sources are giving us these two kind of conflicting signals that we have to harmonize.
That's the challenge.
On one hand, you have this overwhelming structural bias. I mean, the long-term, multi-trillion-dollar strength that's being driven by AI and some really exceptional projected earnings.
A very powerful tailwind.
But on the other hand, you have the immediate tactical nervousness. It's all surrounding the biggest lever of the week, which is, of course, the upcoming Federal Reserve decision.
And the market spent all of Monday just positioning for that one announcement. Every single data point we're about to discuss, from VIX levels to, the divergence in the indices, it's a direct reflection of institutional risk tolerance just before the hammer drops.
Yeah.
So our core mission here is to rapidly synthesize that structural long thesis against the tactical short-term anxiety.
Okay, let's unpack this. I think we have to start with the big picture, the indices, because they immediately tell a story of capital allocation that really defies any simple idea of panic.
Absolutely.
Monday felt like a necessary exhale.
That's a great way to put it.
I mean, we've had this relentless 2-week grind higher, and it pushed several major indices right up against near record territory. Then Monday hit, and our analysis, it nailed the mood perfectly. It said markets displayed classic pre-FOMC trading patterns.
Yes, characterized by measured negative movements. And measure is the absolute key word there.
Right. It wasn't a panic.
No, not at all. This was consolidation. The analysis calls it a technical pressure release candle.
So not a trend break.
Exactly. A trend break would signal a severe shift in sentiment. This is different. When you are positioned for a binary macro event like the Fed, smart money always, and I mean always, takes some profits off the table, they shed leverage, and they move to the sidelines.
They're just reducing their risk exposure.
Right. They reduce exposure, but, and this is critical, they don't abandon their long-term conviction.
And the beauty of looking at Monday's scoreboard is you can see exactly which pockets of the market they chose to sell, and more importantly, which ones they chose to protect.
That divergence between the major indices is a critical signal for a TKIF trader. It tells us exactly where that institutional capital is still flowing, even in a defensive moment.
Okay, let's detail the performance then. The Dow Jones Industrial Average, the DJIA, it faded a bit harder than the others. It closed at 47,771.84. That's down 183.15 points, or minus 0.38%. It basically led the market lower.
And that makes perfect sense.
Makes sense.
It really does. The Dow is heavy with cyclical and traditional blue-chip companies. These are the components most sensitive to rising interest rate fears or just general economic uncertainty.
So when institutions get nervous about the Fed's tone,
Yes, they use those cyclical stocks, the ones with strong recent runs but maybe fewer explosive long-term growth catalysts than, say, tech. They use them as the immediate source of cash.
okay, and the S&P 500, which is a broader representation of the market, it held up marginally better. It closed at 6,851.64, shedding about 18.51 points. That's only minus 0.27%. So a pullback, but a very, very mild one.
It confirms the overall market structure remains intact. But here's where it gets really interesting for our deep dive today.
The NASDAQ.
The NASDAQ composite. It finished the day at 23,545 points, 90 Yao, down just 32.22 points. That's a minimal, a tiny minus 0.10% decline.
Okay, so if the Dow dropped nearly 0.4% and the NASDAQ barely dropped 0.1, I mean, that tells the entire story right there.
It does. That minimal NASDAQ decline, it signals heavy, active institutional support for technology. The broader market fades. But the leadership sectors, the ones driving this AI supercycle, are being actively protected.
It's like a confirmation of the central narrative.
Exactly. The structural long-term trade on AI and mega-cap tech is overriding the tactical nervousness of Fed Week. Institutions are willing to liquidate their more general holdings, but they are holding tight or maybe even accumulating on these small dips in their core leadership bets.
So that divergence is the highest confidence signal we can extract from Monday's trading.
It is, without a doubt.
Speaking of confidence, let's check the market's emotional state. We can do that using the SIBO Volatility Index, the VIX. Ahead of a Fed decision, you often see the VIX spiking as traders, buy up insurance.
Right, they hedge their bets.
But the current metrics suggest a surprising amount of calm.
That calmness is a signal in and of itself. You see, the VIX is sitting at 15.41, which is actually down 2.34% from the previous day's 15.78.
So fear is actually decreasing into the event.
That's what the number says. This reading is firmly in the low to moderate market fear category. It suggests that the market has a pretty high conviction that the Fed's announcement, which we expect on Wednesday, will not contain any massive negative surprises.
So the narrative is stability. But that stability, it often carries a hidden risk, doesn't it? If everybody agrees on the outcome, what happens if the Fed deviates even slightly from that script?
And that brings up the critical caution flag that's highlighted in the analysis. Potential complacency ahead of Fed decisions.
Okay.
When the VIX is low, it just means options premium is cheap. Traders haven't bought enough downside insurance. So if the Fed does surprise, if the language is unexpectedly hawkish, or if the outlook on rate cuts changes, the sudden scramble to hedge could cause a violent, sharp spike in volatility and a rapid market sell-off.
Let's contextualize that VIX reading for a moment. 15.41, it looks low on its face, but we have to remember where we were just a little while ago. The 30-day high for the VIX was 28.27.
That's a huge point. It suggests a massive amount of recent anxiety has just evaporated.
Right.
Traders have successfully navigated the recent uncertainty and are now, largely complacent relative to their immediate past. But now compare that 15.41 to the VIX level 1 year ago.
Which was?
It was 13.54. So we are still marginally elevated compared to that longer-term baseline.
Okay, so what that's telling me is that while the immediate hedging demand has dropped off, the underlying tension from the year's broader macroeconomic shifts, inflation, geopolitics, all of it, that's still lingering under the surface.
That's it, exactly. We're calm, but we're not fully relaxed.
Let's pivot to the sources of strength then. The sector pulse review and the analysis, it confirms the technology dominance that we saw in the NASDAQ's performance. Leadership is firmly in cyclicals, primarily tech and communication services.
Yeah, these are the heavy lifters. Technology, driven by this AI investment cycle, is clocking year-to-date gains of, plus 15.2%. It's the single largest contributor to overall index performance.
And it's not just a cyclical thing.
Now, this performance is structural. It is fueled by the projected multi-trillion-dollar AI capital expenditure supercycle that's slated to run through the end of the decade.
And because of that focus, we have to acknowledge the sheer gravity of the Magnificent Seven. The report rightly reiterates their disproportionate influence. They account for roughly 35% of the S&P 500 market cap. I mean, they are the market.
Their movements dictate the entire market's tone. If those 7 names have an off day, the other 493 stocks have to work overtime just to keep the S&P flat.
And that concentration of value and performance, it leads us directly to the major structural valuation warning that the KING-KAMBUF analysis flagged.
It does. This is where we need to stop being, enthusiastic traders for a second and start being very cautious analysts.
Okay, lay it on us. The S&P 500 PE ratio is sitting at 27.88. That is high. It requires some very aggressive future earnings growth just to justify that price.
It's high, but the more alarming figure, the one that makes true structural analysts nervous, is the Shiller-KP ratio, the cyclically adjusted price to earnings, which is at 40.01.
Okay, for you listening, the CP ratio smooths out 10 years of earnings data. It gives you a much clearer long-term picture of valuation health than just the traditional PE.
A much better picture.
And a reading of 40.01 sounds high. How high is that, in historical terms? Let's put that into perspective.
Well, historically stretched is an understatement. The only 2 times the Shiller-KP ratio has been meaningfully higher than 40.01 were at the absolute peak of the 1999-2000 dot-com bubble.
Okay.
And just before the 1929 market crash.
Wow.
So this metric is ringing a massive historic bell. It is screaming historically stretched multiple.
So if the valuation risk is that extreme, approaching dot-com levels, why isn't institutional money just flooding into short positions? Why does the Kikai framework still maintain a structural long bias?
That is the essential question, isn't it?
Yeah.
The market is not blind to the high KPE ratio. It is choosing to ignore it. And it's doing that because of 2 things.
Okay.
First, the Tenola principle, there is no alternative. Investors are just forced into equities because of low real returns elsewhere. But second, and more importantly, it's the anticipated earnings acceleration, specifically in those tech leadership names.
Right.
The market is pricing in the massive, sustained, double-digit earnings growth that's projected for the 2025 S&P 500.
So the thesis is that, yes, the entire market is expensive, but the growth potential of the tech sector is so enormous that it justifies the current multiple.
And that makes careful stock selection the only viable strategy.
Buying those high-quality names.
Exactly. The high valuations limit your margin of safety. You can't just buy the index indiscriminately anymore. The market is paying a colossal premium for genuine, accelerating growth, and that premium makes any low-quality or speculative name exponentially riskier. That's why the analysis mandates careful stock selection.
Yeah.
We are buying quality or we're buying nothing.
All right, now we get surgical. We've established the macro tension, the structural, long-meeting, tactical Fed fear, and the resulting concentration of capital in tech. Section 2 is about locating the extremes, where the money is stampeding in and where it's running out the door.
This is where the rubber meets the road. And relative strength is the simplest, clearest signal a trader can find. If the overall market is down, as it was on Monday, and a specific sector or specific names are rallying, it demonstrates real institutional conviction.
The two clearest examples from Monday were, of course, the twin pillars of the AI ecosystem. You had NVIDIA and VDA up plus 1.7% and Microsoft MSFT up plus 1.6%.
And they gained ground while the broader Dow and S&P were retreating.
That's the key.
It just solidifies the AI hardware demand narrative for NVIDIA and the continued flow into mega-cap software, cloud, and foundational AI plays for Microsoft. They are, as the professor's read summarized it, the risk-on spine. Institutions want exposure to this theme above all else.
I love that analogy, the risk-on spine. They're the first things institutions buy when they want exposure, and they're the last things they sell when they need to raise cash.
That's it.
But if they're holding on to NVIDIA and Microsoft, where are they getting the cash to de-risk ahead of the Fed? We need to look at the funding sources.
That contrast is vital for disciplined trading. When capital needs to be raised fast ahead of an event, you liquidate your riskier, high-beta, non-essential positions first.
And the clearest casualty here was Tesla.
Absolutely. Tesla, TSLA, showed sharp underperformance at minus 3.4%. Traders are de-risking high-beta auto EV ahead of the Fed, and they're favoring the lower volatility, higher catalyst AI pure plays.
Amazon, AMZN, also saw some mild distribution. It was down about 1.1%. Not a structural break by any means, but certainly a sign that traders are digesting those strong multi-week gains and just taking some marginal profit.
Exactly. AMZN is taking a pause. TSLA is being actively flushed. And it's because it has higher inherent volatility and less of an immediate high-conviction catalyst compared to a Microsoft or NVIDIA. It's a textbook example of institutional preference for quality and low beta positioning just before macro uncertainty.
Let's look at the absolute edges of the market now, the 52-week record highs and lows. This gives us some insight into the long-term structural trends that can transcend all the daily noise.
The strength in financials is really notable here. Names like Goldman Sachs, GS, and Royal Bank of Canada, RY, alongside the industrial giant Air Products and Chemicals, APD, they're all hitting fresh 52-week highs.
And what does that tell you?
It suggests deep institutional confidence in their balance sheets and the macroeconomic environment they operate in. It's a quiet, persistent strength in the so-called old economy sectors.
But the truly breathtaking statistics, the ones that jump off the page, are in the exceptional year-to-date performers. Natera Inc., NTRA, is trading at $244.55. It's up a staggering 2,421.13% year-to-date.
Incredible.
And Cidara Therapeutics, CDTX, is up 1,005.67% YTD.
A 2,400% return in a single year. That's not portfolio management. That's a lottery ticket coming due. And this raises a really important question. What unique catalysts are driving these multi-thousand% returns?
Right.
In biotech, specifically, this magnitude of movement is almost always driven by specific binary events. A phase 3 clinical trial success, a major FDA approval, or maybe a hospital takeover bid.
These returns, they validate the massive asymmetric reward that's inherent in the biotech catalyst space, but they also underscore the colossal risk involved. These companies can trade flat for years until that one binary event hits.
And we see the other side of that binary coin immediately when we look at the 52-week record lows. This is the graveyard of the small cap segment.
We are talking about severe market punishment here. SMOT Digital Group, SDM, was down a catastrophic 86.41%, trading at just $1.85.
And SMX was down over 43%. Naval International Medical was down nearly
It's
40%.
just brutal.
When you see massive single-day losses like this, concentrated in smaller names, the signal is crystal clear. These are severe company-specific crises. We're talking about catastrophic operational setbacks, insolvency risks, or highly dilutive emergency financing rounds that just wipe out the minority shareholders.
It's a vivid reminder that when you stray from the high-quality leaders, you expose yourself to, well, existential failure.
That's the risk.
Moving beyond just price movement, let's talk volume. Where were institutional and retail traders dedicating their energy on Monday, December 8th? Because volume, it confirms momentum.
The clear volume leader was Digital Bridge Group, DBRG. It ranked #1 with 56 million in volume. It paired that activity with a staggering plus 45.27% daily surge.
Wait, hold on. 45% in one day and a 2,023% year-to-date return. That number is incredible. That level of sustained accumulation, it has to suggest a powerful thematic tailwind that goes far beyond just a single news item.
Oh, absolutely. This indicates extremely high institutional and retail interest in the infrastructure and digital asset space. DBRG is capitalizing on the secular trend of investment into data centers, mobile towers, fiber optics.
The physical infrastructure that supports the whole AI and cloud revolution.
Exactly. Its sustained accumulation suggests this isn't short-term noise. This is a thematic play receiving massive multi-quarter capital flows.
We also saw EchoStar Corp, SATs, and Broadcom AVGO dominating volume. Broadcom's high activity is particularly noteworthy because it points directly to market positioning ahead of its massive earnings report later this week.
That's classic anticipatory volume. The market isn't waiting for the earnings print on Thursday. It's placing its conviction bets right now. This shows the strength of the bullish expectations surrounding AVGO's results and its role in the whole semiconductor supply chain.
Okay, so Monday's data, it establishes the starting line. But the price action for the rest of the week will be dictated by three major forces: a massive acquisition, two key earnings reports, and of course, dominating everything, the Federal Reserve.
Let's start with the most immediate, the most clear-cut catalyst that defined Monday's top gainer: IBM acquiring Confluent for $11 billion. This news immediately creates a fundamental floor for CFLT's stock price.
The impact on CFLT was just instantaneous. It was the top gainer, surging plus 29.00%, and it was already up about 27% in pre-market trading, locking in the bulk of that premium. This is a textbook M&A spike.
Right, and it provides a perfect technical setup for our T-KIFE strategy.
How so?
Well, it's significant for two reasons. First, it offers the highest probability trading setup of the week because the price is fundamentally anchored by that $11 billion valuation. And second, it sends a powerful signal to the rest of the market. This is one of the most significant tech M&A activities in recent months.
And that validates confidence.
It validates continued, robust confidence in cloud and data infrastructure valuations across the board.
So IBM, a legacy tech giant, is spending $11 billion to acquire data pipeline expertise. Does that mean that other companies in the data infrastructure space, peers to Confluent, should they also see a boost in their expected valuation?
Absolutely. It creates a ripple effect. It raises the baseline valuation expectations for the entire subsector. When a major player like IBM is willing to pay a high premium for essential data handling technology, it suggests that the market may have been undervaluing other core players in cloud data management.
So this acquisition is really a green light for the whole cloud infrastructure subsector.
Yes. It confirms that the race to modernize data stacks is far from over.
Okay, so corporate performance takes the spotlight next, with two critical reports that could move the entire tech sector.
First up, you have Oracle, ORCL, reporting on Wednesday. Oracle is a major tech bellwether, and the market is hyper-focused on its ability to accelerate AI revenue. The scrutiny is going to be intense, particularly regarding their cloud strategy and their AI infrastructure build-out.
A positive surprise there would reinforce the whole AI structural long thesis.
Immensely. Then, on Thursday, we have Broadcom, AVGO. This is a critical semiconductor report, essentially second only to NVIDIA in importance for the chip supply chain narrative.
And the bar is set extremely high.
Very high. Expectations are for EPS of $1.87, which is a massive plus 31.7% year-over-year increase on revenue of $17.46 billion.
That is an enormous hurdle to clear. Broadcom is such a crucial signal for the health of the entire chip supply chain.
It is, and its stock has already outperformed significantly. It's up near 66% year-to-date, which reflects that high expectation. The confidence is so pervasive that Susquehanna analyst Christopher Rowland actually raised the price target from $400 to $450 ahead of the earnings and maintained a positive or buyer rating.
An analyst giving an upgrade and a significant price target lift right before an earnings announcement. That's a huge input for the tactical trader. It signals strong professional conviction in the outcome.
It suggests the market is positioned for and fully expects a clean beat and raise.
And finally, the gravitational center of the entire week. The thing that has governed the market's defensive positioning all day Monday. The Federal Reserve decision on Wednesday.
The elephant in the room. The entire market narrative is centered on this one event. Our pre-market activity checks confirmed there was minimal directional commitment in the futures market, and that's because professional traders are just not willing to carry maximum risk or leverage into this announcement.
So that confirms the analysis. Traders are moving to the sidelines, cutting risk, and just waiting for the policy signal. But what is the prevailing consensus that they're waiting for?
Well, based on the low VIX, the consensus is that the Fed will likely maintain a constructive, sort of neutral to dovish tone. They are probably expecting the Fed to signal a pause and perhaps hint at a timeline for future rate cuts reflecting the improving inflation picture.
But the danger, as always, lies in deviation from that script.
Precisely. The volatility will be sharp and sudden if the Fed surprises the market with unexpectedly hawkish language, for instance, signaling that rates will stay higher for longer than anticipated.
Which is why the strategy needs to be so precise.
It's why the TKIF strategy must prioritize surgical entry and exit points and much tighter stops for any trades opened on Tuesday, just to protect against that massive binary event risk.
Okay, let's transition now to the actionable intelligence,
Mhm.
the section that translates all this dense data into a practical plan for swing and day traders. We're moving into the specifics of the TKIF framework.
The TKIF framework is really designed for discipline and risk management in short-duration trading. For those who might be unfamiliar, it stands for Technical Kinetics of Institutional Flow and Execution.
And the 20 plus.
The 20+ denotes its utilization of proprietary algorithms that track order flow over the last 20 trading days to identify high-probability turning points.
So it's not just looking at a simple moving average, it's analyzing the actual behavior of large institutional orders to see where the big players are accumulating or distributing stock.
That's the core of it.
Mhm.
It's institutional-grade technical guidance that focuses on three non-negotiable elements: defining clear support and resistance levels, calculating precise risk-reward ratios, or RR ratios, and setting targets based on structural pattern completion. It aims to put the odds squarely in the trader's favor.
Let's quickly define that RR ratio, since it's really the centerpiece of all the recommendations that are about to follow.
Of course, the RR ratio, risk to reward, is simply the potential profit you expect to gain versus the potential loss you are willing to accept. So if a stock setup has an RR of 1 to 2.5, it means for every $1 you risk with your defined stop loss, you expect to make $2.50 of your target profit.
And TKIF only focuses on favorable setups.
Only. It only recommends setups where the RR is overwhelmingly favorable, typically 1 to 1.5 or better. This maximizes the chance of long-term profitability even if you only win half your trades.
The professor's readout for this specific week is critical. It says we are trading short windows, so a Tuesday entry, with a potential Wednesday exit ahead of the Fed. And we are structurally long biased by AI strength, but tactically nervous due to the Fed.
And that mixture dictates the entire strategy. Favor tactical longs on pullbacks. We are buying the dips, not chasing breakouts.
Why is that?
Because the underlying structural strength should absorb any shallow dips. But we must utilize much tighter stops than usual because that tactical fear, the Fed decision, can create violent, sudden drops. The aim is to capitalize on the underlying strength while mitigating the headline risk.
Okay, let's dive into the core recommendations. The 5 top-ranked candidates for 1 to 3 day holds, where the risk-reward is optimal for the TKIF approach. Give us the coordinates.
The rank 1 setup, the highest conviction trade of the week, is Confluent, or CFLT. The rationale here is the IBM acquisition catalyst, which provides an instant, hard fundamental support level. That sets the stage for a major technical breakout.
The numbers are specific. Entry is targeted at a slight dip to the $27.58 range, anticipating some profit-taking after the initial M&A spike. The target is $35.50.
That generates an RR ratio of 1 to 2.5 to 1 to 3.5. That's labeled excellent for a reason. Any pullback offers a highly favorable entry before the stock fully adjusts to that $11 billion valuation floor. The high confidence of the fundamental news just eliminates much of the technical uncertainty you'd typically have with a momentum trade.
Okay, next up, balancing the tech with the ultra-high-growth biotech sector. Wave Life Sciences, WVE, it saw a massive 145.93% gain on Monday. That's a move that requires confirmation.
This is a pure momentum and gap fill trade. The entry and target are aggressive, but they're supported by the 90 million shares of volume. We're looking at an entry at $16 to $17, targeting $25.
And the R.
The RR is 1 to 2.5, also rated excellent. This one requires some patience, though. It's likely a 2 to 3 day hold, waiting for the news-driven momentum to push the price toward the full gap fill target created by whatever the underlying medical catalyst was.
Third, and demonstrating just spectacular sustained momentum, is Digital Bridge Group, DBRG. That 2023% year-to-date performance confirms the institutional commitment here.
The rationale here is infrastructure investment momentum. The trade strategy is a consolidation play. Optimal entry at $13.50 to $13, targeting $18.
An RR of 1 to 2.2, rated excellent.
Yes, we are buying the inevitable dip after that 45% surge on Monday, anticipating that the structural strength in the whole digital infrastructure theme will quickly absorb that profit-taking.
The fourth swing trade focuses on the known catalyst coming later this week, Broadcom, AVGO. This is about positioning ahead of earnings.
AVGO is a strong buy, but the RR is a bit tighter due to its recent run-up. The entry is targeted at a pullback to the $380 to $385 range, targeting $425.
That's a strong 1 to 1.8 ratio.
It is. The technical analysis suggests that buying this pullback into a key moving average ahead of Thursday's earnings is the optimal play. The advice here is to treat it as a swing trade holding through earnings, as a potential upside surprise outweighs the risk of just a simple day trade.
Finally, balancing the portfolio with a low volatility anchor, Goldman Sachs, GS.
This is a financial sector strength play. It's capitalizing on institutional positioning near its 52-week highs of $866.69. We are looking for dips to the $845 to $850 range, with a target of $900. The RR is 1 to 1.5, which is rated solid. It's a high-quality name, and the play is based on the expectation that financial institutions will continue to lead if the macroeconomy remains robust.
Okay, let's look at the high-conviction intraday setups now. These are the tactical moves with a holding period of maybe just 2 to 4 hours.
These are pure momentum continuation plays. They're focusing primarily on those highly active biotech names from Monday. They are in play and expected to see rapid price acceleration on Tuesday.
Structure Therapeutics, GPCR, is one of the top high-probability setups, with a 96% plus daily move on Monday.
The analysis calls for entering on an anticipated oversold pullback. So optimal entry between $66 and $67, with targets running up to $72 or higher. The RR structure is highly favorable. It's suggesting risking approximately $1.50 to make $4 to $6.
So a scalping setup.
Exactly. It's designed for a quick, high-percentage return as the price action consolidates that massive move.
Then we have Fulcrum Therapeutics, FULC, which requires breakout confirmation.
The entry here is at $14 to $14.50, targeting up to $16 and above. The RR is very favorable here as well. You're risking about 65 cents to make somewhere between $1.75 and $2.75. This is designed for rapid entry and exit, capitalizing on the intraday technical structure that suggests further upward momentum following Monday's volume spike.
Now, we have to address the extreme volatility in the microcaps. The volume was immense, but the risk profile is dramatically different. I'm talking about names like Paranovus Entertainment, PAVS, and Cemtrex Inc., CETX.
Yes. PAVS, for instance, moved 56%, and CETX moved 109% in one session, trading 73.4 million shares.
Wow.
The analysis explicitly warns that this high volume and extreme movement suggests potential pump-and-dump dynamics.
So if you're chasing a 109% daily move in a microcap, you're not trading based on fundamentals. You're gambling on someone else holding your bag when the original interest just disappears.
That's the reality.
Yeah.
For these highly speculative setups, the recommendation is clear. They are speculative buys only. You have to use tight stops, you have to reduce your position size dramatically, and you have to prioritize quick exits over chasing extended targets. If that institutional interest is purely momentary speculation, you need to be nimble enough to get out before the inevitable crash.
The risk is binary.
Completely. And the trade is based on technical noise, not structural conviction.
We have the names and the coordinates, but execution is everything, especially heading into Fed Wednesday. Let's detail the 2 preferred tactical archetypes for Tuesday trading.
The primary strategy is what we call the leader pullback long. This uses the strongest names, that risk on spine, as your vehicle. So we are talking QQQ, MSFT, or NVDA prioritized over the broader SPY or DIA.
Why the preference for the technology vehicles like QQQ?
Because Monday's relative strength confirmed that institutional accumulation is happening there. They are the market's shock absorbers, and they are the most likely candidates to lead the market out of this pre-FOMC consolidation.
And the entry rule is very specific.
Highly specific. You only enter if the cash open on Tuesday is flat to slightly red, but it must hold above Monday's low.
So we're looking for a shallow dip that respects the previous day's floor, which signals that momentum is cooling, but it's not a trend break.
Precisely. You look for the price pulling back toward the rising 5 to 10-day moving averages on the intraday charts. That's the optimal TKIF entry zone. You scale into the position, maybe half on the first touch at that defined support, and the remainder on confirmation like a higher low or reclaim of the volume-weighted average price, the VWAP.
For you listening, the VWAP is simply the average price of a stock weighted by volume. If the price reclaims the VWAP, it suggests that most traders who've traded that day are currently in profit, reinforcing the upward direction.
Then we have the second strategy, the speculative rebound play. This uses names that were sold off hard like TSLA at minus 3.4%. We call this the de-risked high beta rebound.
Tesla is highly volatile. It can snap back violently. What are the constraints on trading something like that?
Extreme tightness. You can only consider it if it holds Monday's low and opens flat or slightly higher on Tuesday. That would indicate the flushing is over. If those criteria are met, it allows for a small-sized bounce toward VWAP or a small 1 to 1.5% profit target.
And position sizing is key.
Crucially, you must significantly size down this position due to the higher inherent risk compared to a mega cap like Microsoft.
The KAMBUF reserve strategy lives and dies by its risk management rules. These are the non-negotiable foundations for survival, especially in a Fed week.
First and foremost is the hard stop loss. You never risk more than 2% of your capital on a single trade. This protects the portfolio from the binary risks inherent in high-velocity trading, and it ensures that one bad trade cannot materially impact the portfolio's integrity.
And the discipline on the exit is just as vital as the entry.
Oh, absolutely. The framework emphasizes securing profits progressively. We recommend taking profits on 25% to 50% of the position at the first defined target, rather than chasing extended targets with the full position.
That locks in gains and reduces risk.
It allows the trade to become risk-free once a good portion of profit is secured.
And directly related to the looming Wednesday announcement, FOMC positioning.
Avoid overnight holding of high-leverage positions ahead of the Fed decision. You have to reduce leverage dramatically on Tuesday afternoon. If you must carry risks through Wednesday, focus exclusively on liquid megacaps, the NVIDIAs, the Microsofts, the Broadcoms, which can be easily exited even in violent volatility. You must expect sharp, erratic price swings post-announcement.
And your portfolio needs to be positioned defensively to withstand that initial shockwave.
It does.
What is the ultimate hedge discipline? When does the analysis say we must flatten everything and go to cash?
If the S&P 500 breaks below Monday's low with momentum, that is the non-negotiable universal signal to flatten the entire basket of risk. That would indicate that the pre-FOMC anxiety has broken the structural integrity of the recent rally, and it would require a complete reset of our trading bias to defensive or maybe even tactical shorting.
Let's consolidate the outlook for the remainder of this high-stakes week. What are the key indicators supporting the continued upside bias?
We have several powerful tailwinds. We have a declining VIX at 15.41, which signals reduced systemic fear. We have strong upcoming earnings catalysts from bellwethers like AVGO and ORCL. We have M&A confidence validated by that IBM CFLT deal. And we have clear technical momentum and institutional protection in leadership sectors like biotech and tech. The structural AI long thesis remains very much intact.
But the caution flags are just as potent, reminding us that discipline has to prevail. Where should you be most vigilant?
We face three major risk categories. Structurally, the highly elevated S&P 500 valuations, that PE of 27.88, the KPE of 40.01 mean there's limited margin for error.
Right.
Event-based, the major FOMC risk is the single largest tactical threat. And speculatively, the extreme volatility in microcaps like CETX and PAVS, with their 109% daily moves, suggests pump-and-dump dynamics are in play, requiring maximum caution.
So, synthesizing structural strength against tactical fear, what is the final recommended action for the trading portfolio?
A strategy have to be surgical. You establish core long positions in high conviction, Fundamentally supported names, Confluent, Broadcom, Goldman Sachs, but only on pullbacks to define support respecting the structural long thesis.
And second,
Secondly, you prioritize swing trading the highest momentum biotech names, GPCR, FULC, WVE, but you commit absolutely to those tight 1 to 3 day holding periods. The overarching rule for Fed Week is clear. Trade the edges of the established range, never the volatile, headline-driven middle.
that recap brings us back to the core test of the week, which is discipline. The market has this undeniable structural strength anchored by the AI narrative and massive M&A confidence. But the tactical noise and the binary risk of the Federal Reserve, it just requires surgical precision in both entries and exits.
It does. Success this week will be determined by how well you manage your risk, not by whether you predict the Fed's exact words.
That was an incredible deep dive. We really pulled out the specific levers, the $11 billion acquisition, the analyst confidence in Broadcom, and the subtle VIX behavior that define this exact market moment for you. We've dissected the difference between the structural long bias in tech and the tactical fear that's driving short-term profit-taking and everything else.
A great summary.
And this leads us to our final provocative thought for you to consider. We see the market supporting the AI supercycle with strong year-to-date returns and institutional flow into tech. It's validating the valuations of names like NVIDIA and Microsoft. But if the Fed's stance surprises the market and triggers a genuine flight to safety, not just a pause but a break in structural confidence, how quickly would those very same long-term structural leaders, the highest value, highest liquidity stocks in the world, turn into the primary funding sources that traders sell first to raise cash? It's a crucial question of whether structural strength can truly outrun tactical fear when the policy environment shifts abruptly and violently.
Liquidity always wins when fear strikes.
Yeah.
That's the one constant the TKI framework is designed to protect against.
We encourage you to apply this synthesis to your own knowledge base and portfolio. Until the next update from the Reserve of KING-KAMBUF Financial News and Reports magazine, be disciplined, manage your risk, and happy trading.